Ironically, the conversations I have with European investors is it's not we can't invest in the UK, it's why haven't the UK institutions invested in the UK? That's normally the first question that you have to get over. So we have Dutch investors and we're having detailed discussions with Danish investors as well. So we have a sort of a fairly tax transparent process in which people can enter into our fund structure. So it works well, it's been designed for international investors. I think the US have such a huge market, for them to put meaningful sizes of capital means they have to get an extra level of return from their own domestic market, and then you've got issues of currency hedging, etc. So you've got to think very carefully about, they're looking probably more at an opportunistic type return than they are a sort of core return, which is what effectively we're offering from UK residential. So Euro investors are there. We're seeing the Australians beginning to explore UK residential, but their own bond rates in Australia are very high. So to add a risk premium on top of that makes it quite difficult for them to enter into this market, but it is a good diversifier and they recognise similar parallels. I expect to see some Chinese coming more to the market. There's a big difference between opportunistic prime central London, or what was opportunistic prime central London in the UK, and then what is a sort of core regular type income producing asset. So I think we'll see a lot more Europeans coming into the market, should they find the avenues to enter in.
Well, first of all, I think we have to divide. If we talk about the German residential and the great transactions that have been done and will be done in German residential, there's a lot of local German money from the stock market that is invested at the moment, because in Germany we are creating great listed companies that are dealing with residential, with pockets of very cheap money, and that now have to increase their portfolios, and they will do many of the greater transactions. That it would be my impression. Well, what we see at the moment on the commercial side is we have seen Chinese investors coming especially to Frankfurt, making great deals. We have seen for the first time making great deals like family offices investing more than 500 million in one asset. We have seen a fund from Japan that has invested, and our expectation is now that dealing with many of the Swiss family offices and ultra high net worth individuals, they have not spent money in the residential or in the commercial property sector in Germany back then, but 2 weeks ago on this crucial Tuesday, the Swiss franc dropped 20%. No, it not dropped. The euro dropped 20%. So our Swiss investors, they are now chasing us to say, okay, you have to find product for us in Germany now. It gets very, very interesting to step into the market. They want to do this not only because the prices now for them has become cheaper, but also they're very, very they're in trouble with they will get in trouble with their economy in Switzerland, because the touristic sector will not work again with this strong franc. They will, from the producing sector, they will get in trouble. So they don't want to invest in Switzerland, especially in office spaces at the moment, and they want to step out into Germany.
Okay, good. Did you want to pick that point up?
Possibly a little bit of comment on it. I think looking at the investment landscape in Europe, I think one of the issues is that, especially if you talk to the Eurozone investors, looking at the UK, they have the hedging issue, because a lot of them, they don't have some kind of balance sheet hedge with liabilities, so they have to hedge, and therefore they needed the premium on the yield side to really be able to come over here, which is not really the case in most instances. At the same time, more and more talking to the investors, they realize just going to a foreign country, they not historically demanded a premium, but they realized, okay, especially looking at the European residential markets, you have a high degree of diversification because of the different regulatory levels around. So the correlation is very low, in some cases even negative. So they realize that they might not need a premium on the yield side, but at least they should have the same yield level than in the home country, and that in some cases is still an issue to really be able to generate the same yield level. And given the Swiss side, I'm not convinced that the Swiss are now much more active, because they now realize that they have a different risk level they haven't had in the past. Given that the currency, you never know what's happening on that side. you might hedge, they might hedge now, so, or they leave an open position believing that the euro will strengthen on a 5 to 10 year horizon, which might be a good bet, but at the same time it gives you a fluctuation in your assets you're investing in. They possibly won't like. So I'm quite curious what the Swiss investors will really do, and not like talking about residential in the last 5 years. Nobody did it. In the last 12 months, we've seen now things happening, and I'm not quite sure if maybe the Swiss are also not trying to look at a lot of things right now, but what are they actually executing in the next 6 to 12 months.